Put up your hands. How many of you think the market will go up? Put your hands up. So only one of you thinks the market will go up. How many of you think the market will go down? Okay. Now, that's just a simple exercise. The market will go down because more people are going to sell than are going to buy. It's as simple as that. The reasons why they put up their hands, you don't know, do you? You don't know why they put up their hands. But that's what happens in the market. It's as simple as that. If more of you had said the market was going to go up, the market would have gone up. And that's how the market, so it is illogical. It's the majority rules. If more people are selling, the market will go down. If more people are buying, the market will go up. Why they're buying, why they're selling, you don't know. And it could be for silly reasons. Panic, retirement, cashing out, whatever. So that's why I was saying, as a trader, you have to be careful about that. So as a trader, I always say you don't use the words always or never. You won't say, oh, if the market always goes up when they increase interest rates, or it always goes down when they increase interest rate. No. You can say it might, or it tends to, but you don't use those absolute terms, always, never. You don't use, so going back to what I was saying, the market tends to trend sideways prior to a report of high importance coming out. Tends to, it doesn't mean it always does, tends to. So you have to be careful trading prior to a report of high importance. So most traders today will be very cautious trading today before 12 noon. And that's why it's important to check the economic calendar. And that's why he's got it on his trading plan, to check the economic calendar. Now he says here he will place one very cautious trade before a report of high importance comes out, and then place a trade after the report. So he's saying that, yes, the market tends to trend sideways, but things can happen and the market could trend prior to the report coming out. So just in case, he will have an order in a very, very safe and cautious place in the market, just in case. But if he happens to get into the market and the market takes his order and he loses out, he won't trade again till after the report. Then he checks the one-year daily chart for an overview of the market. So again, you can see he's stated the time frame, 1 year daily. I'll use the 2 days, 5 minutes chart and pivot points for entry into the market. So that's for the day trading. He's stated the time frame and the indicator is going to use. So again, he's going to use the moving average 50 as the trend indicator and will only trade in the direction of the trend. Again, he stated the indicator he's using, and the rule of thumb is you always trade in the direction of the trend. The trend is your friend. That saying is as old as the hills. Always trade in the direction of the trend. If the market is going up, you buy. If the market is going down, you sell. If the market is going sideways, you keep out. It's as simple as that. The market can only go 3 ways, up, down, or sideways. You go up, you buy. It goes down, you sell. Sideways, you keep out. And Mr. Smith uses the moving average 50 to give him an idea of which direction the market is going. Then he states here his trade contract size, 50p per point, starting with a capital of £100. So again, he stated his money management, how much he's going to risk per trade. That's part of his trading plan. He says he's going to use the risk-to-reward ratio of 1 to 3. He's going to use a stop loss of 20 points, profit limit of 60. And you're getting the idea. So if you place a trade and you did not apply all these rules to your trade, then you're a bad trader. Even if you make money, that was a bad trade. So if you place a trade not following your plan, I always tell people when I train them that even if you lose money at the end of the day, but you stuck to your trading plan to the letter, that was a good trading day. So a good trading day is not whether you made money or lost money. A good trading day is a day you stuck to your trading plan. So if you made £1 million on that day, but you did not stick to your plan, that was a bad day. Because if you carry on those bad habits, you will soon lose that £1 million and more. If you stuck to your trading plan but you lost money, don't worry, you will make a lot of money if you just be consistent. So that's the thing. So you can see here, he says, he's put his stop losses there. It says when the market is trending sideways, I will not trade within a sideways trend. So again, if he lost money trading within a sideways trend, he went against his plan. When he's had 3 consecutive losses, he stops trading for the day. Why is that? Any guesses why you stop trading once you've had 3 consecutive losses during the day? Yes?
Because it might go behind your head, so you might not make wise decisions. I'm just having a guess.
Yes, that's a good guess. Any other reasons? After 3 consecutive losses, you stop trading. Well, this is his plan. Why is that? Yeah?
As maybe a downturn trade.
Well, you could still make money in a downturn. Yes?
You say in poker that you go on tilt.
Sorry?
So you say in poker that you go on tilt, so you're like, you know that expression? You start to tilt, so your mind starts to
True.
desperate and you start.
Yeah, that's a good one, yeah.
Is it preservation of capital?
Very good. Very good. Yes?
You're tempted to take more trades to recap your losses, and you might do even more of those.
Yeah. Yeah. But that's the best one. Preservation of your capital. Again, this is where I was talking about money management is the most important part of your trading. You do not lose all your money in one day. Preservation of your capital is the most important thing as a trader. Tomorrow is another day. Don't blow your money in one day. And remember, every time you place a trade, what are the chances of you having a losing trade? What percentage chance do you have of losing money anytime you place a trade? Sorry? Yeah. You have a 60% chance of losing money every time you place a trade. So if you keep going, you're just going to keep losing money. And then your account is wiped out, and you have no money the next day to trade. Again, this is where people fall apart as a trader. Because that's the thing about trading. That's why I was saying you have to put the 3 M's together. Emotion, discipline. I mean, the other answers you said were very good. Because after 3 losses, emotions are coming in. I have to recoup these losses. You keep going. You keep getting frustrated. You're all over the place. But you can see that is why those 3 M's are crucial. Every time you place a trade, you have a 60% chance of losing money. So after 3 losses, stop. Tomorrow is another day. When my profit target has been achieved, I stop trading for the day. So if you place your first trade and you're successful and you achieve your profit target, you stop trading. Why is that? Yeah? Exactly. Another reason? But very good answer. Another reason? I've sort of given you the answer in my last. Very good. Very good. Very good. Because again, remember, every time you trade, you have a 60% chance of losing money. You have more chance of losing money than making money. So if you place a first trade and you make money and you then keep on trading, you have a high chance you're going to lose what you've made. Yeah, so that is why, again, money management, trading psychology, method, trading plan, it all comes together. You can't do it in isolation. You always have to remember all these facts. You place your first trade, you're successful, you've made your 60 points, stop. You've made your money for the day, wait till tomorrow. If you keep going and going with those odds against you 60%, you then wipe out. One, you might lose your profit and then start losing money. Yeah? You're going to ask a question?
This is kind of strange, but let's say you either make 3 losses by 10 o'clock in the morning, you lose, or you make your profits by 3 o'clock, 10 o'clock in the morning. What do? You just research the rest of the day? You back up, go home?
That's a good question. Again, I'm a private trader. I don't work for anybody. And that's what I love about trading. I can make my money in the morning and go and enjoy the rest of the day. That's what financial freedom is all about. I don't want to be stuck in front of the computer. You know, wake up, make your money, make your one, and off to the golf course, off to go and have fun with your friends. And I have other businesses I have to run anyway. I have the coffee farm, the property construction company, and the charity I have to run. I have my family, I have friends. I still work as a GP 2 days a week. So make your money go. I don't want to give it back to the markets. Yeah, but yes, the mistake is that if you remember the fact that every time you trade, you have a 60% chance of losing, then you should be happy once you've made your money, don't keep going. You're going to give the money back to the market, and ultimately, you're not going to be profitable. Okay? So basically, that's what that means. So your first trade, if you're successful, you stop. If you're not, you go to trade number 2. If trade number 2 is successful, you stop. If it's not successful, you go to trade number 3. If that's successful or not, that's the end. You stop. Yeah? But you can see from the previous money management spreadsheet I showed you, it all depends, because you can see if you were trading with 200 grand in your account, you could be making, you know, thousands and thousands of pounds in a day. It all depends on the size you're trading. So you don't really need to keep going all day. And don't forget, hopefully we'll have time for that. There are other things. You might have a swing trade going on. Because I day trade, I swing trade, I trade options. So I have options trades that are going on anyway. I have swing trades that are going on anyway. And you have other streams of income. So I don't have to, you know, once I make my money, I'm out. This is a spreadsheet. It's a simple spreadsheet. Because usually when I teach people how to trade, I have this online mentorship and training program where we trade live every 2 weeks, every 2 months for 2 weeks. We trade live. I trade live with the guys I teach how to trade. And I mean, this is the spreadsheet from July. So every 2 months, July, September, November, January, and we have one coming up in March, next month. So we always, again, this is how you become objective. So again, I get them to use that plan. We all trade together. We all analyze the market together, focus on one market, usually the euro-US dollar, and then we trade. And again, as I said, I get them to start with 100 pounds. Can you all see the figures? Yep. So you can see this is when we started. We started on the 12th with 100 pounds. On the first day, we lost 10 pounds. Yep. We lost 10 pounds on the first day of trading. But that's sticking to the plan. We lost 10 pounds. But you can see here, we wrote there it was a good trading day because I stuck to the trading plan. It doesn't matter whether you made money or lost money. So despite the loss, we still stuck to our trading plan. The next day, we made 30 pounds. Again, good trading day, not because we made money, it's because we stuck to the trading plan. And you make other comments, like we made a comment the market was trending sideways prior to the report coming out. So observations you see on the chart and the market, you make observations. So when you go back, you can reflect objectively. The next day, we lost 10 pounds. This is real life trading and real life money in a real life situation. We lost 10 pounds, but again, good trading day because we stuck to the trading plan. And I think we went on that way. We made 30 pounds. We lost 15 pounds here, but it was a bad trading day because we deviated from the plan. We deviated from the plan that day, so it was a bad day. Here, in fact, this is a good example. This was the end of the week. At the end of the week, because we had a profit of, you can see we went from £100 to £125, a 25% increase. So we withdrew £25 out to take out some of your profit, and we brought the money back down to £100, because I always get them to get a habit of slowly withdrawing their profit. Then we started again. First day, again, we lost £30, but again, it was a good trading day. We had 3 consecutive losses. Yeah? We had 3 consecutive losses. So it went from 100 to 70. But again, it was a good trading day because we stuck to the plan. We had our 3 losses and we stopped trading and we lost £30. The next day we made 30. We had 3 consecutive days of a £30 profit. And you can see here, and at the end of the 2 weeks, we were able to withdraw £70 again because we went from 100 to 170, so we took 70 out. And I think out of the 2 weeks, we withdrew £95 from an initial starting capital of 100. So that was a 95% profit in 2 weeks. But you can see how it works. Yes, you're going to have good days, you're going to have bad days, but what made us successful was the fact we stuck to the trading plan. And that's what we do every time, and we have similar results. So usually, it's always fun doing this 2 weeks because people can then see with real money, real life, them trading their own accounts at home, that this works. And the key is consistency. And luckily, when they come back to me and they failed and they're losing money, they're at least honest enough to say they were indisciplined, not sticking to the plan, chasing the market, doing all sorts of emotional things.